Sir, if you want to give a break, just why it is in on. Sure. To take a break, just click once and keep that.
Okay, sure.
Once again, just drop it in on. Sir, still not ready?
1 to 5 I need, that's it.
And I asked you a couple more things, sir.
Sure. Yeah.
I didn't have your number, sir.
We should exchange actually. Sure. Okay. Sure. Thanks.
Projector remote, AC remote.
This is AC. Projector remote, why do you need it for? I don't know. Okay. Okay. How do I get the feedback from them? How? And for me, if somebody asks me a question, how do I know? Okay.
You can give 10 minutes or something breaking between after.
Sure. Maybe each unit I'll give 5 minutes break. Okay. Sure. Sure. Okay. Good morning all. Sorry for the delay. So let's start with the unit 1. So there are about 9 units for the whole course. I'll be covering first 5 units as part of today's class. I'll be taking class till 2 o'clock. So we will see the rest of the slides, rest of the units in the next class, which is happening on Sunday, the first Sunday of the September. Okay. So to start with, so let's start looking at finance functions, goals and objectives, and also some ethics. So what is what? So let's look at basics. What is finance? Finance can be defined as the art and science of managing money. Yeah. So you all know, be it a finance graduate, management graduate, engineering graduate, we all have to manage our money at some point of time. The moment we start earning out of our salaries, out of our business, we have some income coming from other sources, we have to manage them and ensure we get maximum bang for our buck. So that's how it all boils down to the financial management. Finance is concerned with the process, institutions, markets and instruments involved in the transfer of money among individuals, businesses and governments. So what are the aspects that are involved in finance? If you look at holistically, these are the pieces that are involved in the whole gambit of finance. Yeah. So 3 questions to be addressed by the study of finance. Capital budgeting decisions, capital structure decisions, working capital management decisions. So what do we mean by capital budgeting decisions? long-term investments that a firm should undertake. Say for example, you have a business and you should take a decision as to what are the long-term investments that my company has to make. Yeah. So those kind of decisions are called capital budgeting decisions. And we also have capital structure decisions, means I have decided what are the long-term investments that I have to make, but how do I fund those investments? Where do I get the money from? Is capital structure. Is it an equity? Is it a debt? Is it a loan? How do is it the creditors that give me money for some amount of time? So that's how I look at that. So capital structure is that. Then coming to the working capital management decision. How can the firm best manage its cash flows as they arise in its day-to-day operations? So the moment you start running your business on a daily basis, you would need cash for small little expenses like office coffee expenses, travel expenses. So those are the kind of expenses that you have to manage on a day-to-day basis. Maybe you should buy you buy something out of quick decision, that you buy some stationery, or maybe you buy a couple of laptops for the office. So that's how the working capital, whole concept of working capital kicks in. So that's the kind of decision that you have to make. How do I manage the day-to-day operations, the cash requirement for the day-to-day operations of the firm? Okay. Let me rearrange this little bit. Okay. So we have scope of financial management. So let us look at what are the aspects that fall under financial management scope. So it talks about essentially the financial management, and the scope talks about we have to understand the financial requirements. We have to estimate our financial requirements, deciding capital structure. So first we have to understand what kind of requirements we will have financially to run a business, to start a business or run a business, right? And then we will look at the capital structure decisions. We just discussed about that in the previous slide. Selecting a source of finance. Again, we also discussed this in the previous slide. The second question that we discussed, capital structure, is that. So we are looking at selecting the finance. Is it debt or equity or loan or what? Creditors. How do I fill in my liability side of the balance sheet? Basically, yeah. If you ask me to speak technically, if you are from a commerce background, you would understand how do I populate the liability side of the balance sheet is what we talk about here. So deciding on the capital structure done, selecting the source of finance done, selecting a pattern of investment. So how do I invest money in where and how much is what we look at. Selecting pattern of investment. Should I put all my money in equity? I mean, take my money in equity and put everything in fixed assets, or how much in current assets, how much in debtors, how much in short-term investments? Yeah, that is what we look at. Then we have to understand proper cash management. Again, working capital. On a daily basis, we would need cash to run the operations. That's very critical for the business. So how we should know, we should never run out of cash on hand. That's very important for any business to run, and we should know how to run the cash cycle, so to speak. Implementing financial control. So important, another important aspect is controlling of the whole activity that we have established in a company. Yeah, we need to have controls in the right places, ensuring the funds are being utilized in the right way, in the right direction, as per the plan. And there is no wastage of money or any of the finances whatsoever in the business. Proper usage of surplus. So good that we are able to get some profits. So we have got some surplus cash on hand based out of our profits. So how do I use that? How do I make use of that? And how efficiently I can make use of those surpluses so that it gives me maximum returns when I put them to use. So these are the basic aspects of scope of financial management. We also have we need to look at establishing business priorities, and once that is done, we will all specifically look at specific to financial management scope. Yep. Okay, before I move on, I would like to tell you something. Once I am done with each unit that I am trying to cover today, about 5 units today, I would like to give a 5 minutes break maybe, yeah. And in the meanwhile, if you have any questions, you can route those questions to me, and I'll try to answer before I start unit 2, the next unit, yeah. I'm not able to understand if you have any questions right now, because I don't have anything to tell me that you have a question. So keep those questions handy. Once I'm done with the unit, you can shoot the questions and we'll try to answer that before we start the next unit. Yeah? Cool. Finance functions. So what do we mean by finance functions? Going back to the previous slide, so we are looking at investment decisions, finance decisions, and dividend decisions. This is something new that we are looking at here. Okay? So investment decisions, again, what kind of investments that I have to make to run the business, and how do I finance those investments, and how do I handle my dividends when I get there. In other words, the firm decides how much to invest in short-term and long-term assets and how to raise the required funds. Yeah, this is what I meant, investment decisions. How much I should put my money in short-term, how much put my money in long-term assets, like fixed assets, current assets, debtors, short-term investments. I just explained that in the previous slide, right? So that's how it is. And managerial finance functions. The size and importance of the managerial finance function depends on the size of the firm. In small companies, the finance function may be performed by the company president or accounting department. Okay, let me give you this, the duster. Yeah. So if the company's size is very small, say as a group we start up a new company and we don't have enough people to handle those finance specific functions. In such cases, what we have to do is, as a CEO of the company, I run around for the management decisions, the business decisions of business development, including legal aspects, also the financial aspects. So even if I'm a company's president, I would run around. If it's a small company, if it's a big company, I can afford to have a different department for accounting, and then it is little inconvenient to look back into the board every time. So what I'm doing is I'm trying to open the slides on my laptop so that I can keep track of what's happening. Yep, just give me a second. Okay, so we are in the so managerial finance functions. The size and importance of the managerial finance functions depends on the size of the firm. Yeah, that's quite evident. The moment I have a small company, the managerial finance aspects are a lot lesser because I have a lot lesser funds. If I'm growing into a bigger company, private limited company, then I grow on to become a public limited company, then my functions of specific to management and the finance will grow up eventually, and I need to have a separate team to handle those aspects, right? In small companies, the finance functions may be president, and as the business expands, finance typically evolves into separate department. The finance relationship to economics, yeah. The field of finance is actually an outgrowth of economics. You see, if you come from a commerce background or an accounting background or a BBA background, you would understand this, because economics and accounting and finance are all closely knit. It's all talking about money and how do we use our resources, how do we put them to use, optimum use, get my maximum returns and stuff like that. In fact, finance is something referred to as financial economics. So some intellectuals say, some authors say, refer it as financial economics. Financial managers must understand the economic framework within which they operate in order to react or anticipate to changes in conditions. Say, as a financial manager, or a finance manager of a company, you should understand how the economy is working in the country that you're operating, and what are the impact of those changes in the economy that's happening on your business, so that you take right decisions to manage your finances a lot better in line with what's happening in the economy. If the markets are crashing, then you look at some set of decisions. If your market is booming, you look at some set of decisions. And again, the kind of industry that you're working in, yeah, that is something that I wanted to make a note of here. So say for example, if you're an IT company, the kind of economics that drives the IT sector will again have an impact on the kind of company that you're working in, yeah, IT company, or kind of the finance department that you would like to run in that company. Again, if I'm in an automobile company, if there is a change in the economics, a global economy in automobile sector, that is having a direct impact on the kind of production and manufacturing that I do in the automobile industry. So something on similar lines, you will have to understand the economic aspects framework within which your company and business works. Yeah, and we need to also understand the marginal cost benefit analysis. So that means for every additional cost incurred or unit of cost incurred, for every additional unit of production done, what's the marginal benefit that I'm getting? What is the marginal profit I'm getting? Additional unit of profit that I'm getting for that particular unit. So that's again tightly knit with economics that we talk about here. Primary economic principle used by financial manager is marginal cost benefit analysis, which says the financial decision should be implemented only when added benefits exceeds added costs. So for every new unit that I produce, say I'm a manufacturer of say pen like this, or marker, a pen or pencil. I have a small unit. So for every additional unit of pen I manufacture, I may incur about 2 rupees of cost. If the additional pen of the production of pen that I do is getting me 5 rupees as profit, or at least 3 rupees as profit, which is 1 rupee above the cost, that's marginal cost benefit analysis. That is a feasible thing to take forward. As a manager, you will look at that granular level to understand what's the cost impact and the benefit impact. For every additional rupee you spend, what is the amount of benefit you get, is what the marginal cost benefit analysis talks about. Then we have treasurer and controller. This is more into the kind of controlling functions that we spoke about earlier. Finance controller, treasurer, closely related or overlapping. The financial manager, okay, in a smaller firm, as I said, if it's a small company, one guy will run around for everything, take care of accounting, auditing, the sourcing of funds, investments, all the stuff. If it's a bigger company, we will have dedicated teams, dedicated set of people with specialized skills who can take care of those activities. Yeah. So treasurer is one who actually sources the funds for the company, and the controller, let's go back to the slide. Controller, who is actually controls the kind of the whole functional framework that we have built in the company. Okay, so then one major difference in perspective and emphasis between finance and accounting is that accountants generally use accrual method, while in finance the focus is on cash flows. Okay. If you have studied accounting, you would understand this piece. Let me explain you and take a minute to explain the whole thing. So when you talk about accountants, specific to the set of people who take care of accounts, they do prefer accrual methods, while in finance they look at the cash flows that are actually happening into the company. We can have an example in the coming slides and talk about it in detail. Significance of this difference can be illustrated using the following simple example. Okay, so we have this company called Nassau Corporation experienced the following activity last year, which is sales. It sold one yacht, 100% still not collected. So there is a company, this company which has sold one of the yachts for about $100,000. Yeah, and the cost is about $80,000, all paid in full under supplier's term. So we have paid all the cost as per the supplier's requirement, and we are yet to receive $100,000 from the buyer who got the yacht from us. How do I look at it in an accounting fashion and a finance fashion? So that's the difference we are trying to make out now. The contrast, the difference in performance under the accounting, yeah. Then we move on to accrual and cash. We have income statement summary. So under accrual, it says we have received $100,000 as part of the sale. So we go say sales $1 lakh, $100,000. Then on cash, if it is on the same thing to be understood as cash received, we will not say that we have made any sales because we have not got any cash. At the same time, we deduct $80,000 that we have spent as costs. So in accrual basis, we end up having $20,000 as profit, whereas under cash, we end up having $80,000 as loss. Yeah, you are able to make the difference. So in this case, let me point out the point. So in this case, we consider $1,100,000 as the income that we have received from the sales proceeds as sales, and we deduct 80,000 to get the profit. But in this case, we don't have, because we have not received the cash actually. We only have incurred the loss, which is deducted here to show a loss, and this is profit. Okay, now moving on. Finance and accounting also differs with respect to decision making. While accounting is primarily concerned with the presentation of financial data, the financial manager is primarily concerned with analyzing and interpreting this financial information for decision making purposes. Yeah, so accounting is basically to ensure all the bookkeeping is done properly, ensuring all the entries are passed, and we have all the information that is recorded on the books. But financial manager, he starts his work once all this accounting is done, and then he looks at what kind of inflows have happened over a period of time, what kind of outflows have happened over a period of time. Are we putting our money in the right places at the right time, at the right amount? How do I manage this? How do I ensure the right amount of money is going into the right direction at the right time? Is what the financial manager works on. Yeah, it is more about analyzing and interpreting the whole data that an accountant prepares. So accountant is responsible to start with journal, ledger, then trial balance, final accounts. Yeah, and the financial manager looks at a balance sheet and an income statement, and then starts looking at why is this like this, and then looks at ways of tweaking the whole flow of cash, the way it is moving within the company or moving out of the company, and those kind of interpretations he will do with and then takes the right decision to use the money that he has got in the company in the right way. The financial manager uses this data as a vital tool for making decisions about the financial aspects of the firm that we discussed. Okay, so moving on. Primary activities of the financial manager. So financial manager looks at the balance sheet. I just spoke about that. Balance sheet has got two sides, assets and liabilities. Actually, if you look at a balance sheet in the real life scenario, let me get up. So the balance sheet will have assets this side and liabilities this side. Yeah, in this case it is little different. Just to interpret, don't consider this as a balance sheet. It is just an a representation of what a financial manager does. So he looks at the assets, the current assets and the fixed assets, and ends up making investment decisions. We spoke about this in the earlier slides. One of the primary function of a financial manager too is to make investment decisions, current assets and fixed assets, how much I should put money in here and how much I should put the money here. And again, decisions in terms of liabilities, how do I fund these? How much of long-term funds, how much of current liabilities I should get to run my business. So this is how he looks at long-term funds. Can be equity, debt, again debenture, long-term loans from third parties, and the creditors for liabilities. Yeah, and we are waiting for some payments to happen from our buyers. That's kind of again creditors. Yeah. So which investment is preferred? Which financial goal of the firm, maximizing the profit, is something critical that we have to understand. As a financial manager of a company, your primary goal is to maximize the profit and to maximize the wealth of the shareholder. So which investment decision, which investment is preferred here? Let's look at this example. We have two investments, rotor and valve. So year 1 we have $1.4 as earnings per share. Year 2 we have $1 per share. Year 3 is what? $40.4 per share. Valve $0.6 per share year 1, $1 per share year 2, and 1.4 on year 3. Profit maximization fails to account for differences in the level of cash flows, the timing of these cash flows, and risk of these cash flows. Financial goal of the firm, maximizing shareholders' wealth. Why is it important? Because shareholders are the owners of the company. They have given their money to run our business. As a manager, I should understand, I should be ethically involved in maximizing their wealth. Because maximizing shareholders' wealth properly considers cash flows. Again, by doing this, cash flows and the timing of these cash flows and the risk of these cash flows, this can be illustrated using the following simple stock valuation equation. Future dividends divided by required return, that level and timing of the cash flows and risk of the cash flows that we look at. So the process of shareholder wealth maximization can be described using the following flow chart. I'm so sorry. Yeah. Shareholder maximization, financial decision and share prices. Financial manager starts working here. He will have financial decision alternative and actions, decision alternatives and actions. Return or risk, he will have a look at how much return, how much risk he can afford to have. Then he will also look at, should I increase, is it increasing the share price of the company? If yes, accept. If no, reject. Looks very simple on the flow chart, but in the real life, it is not that hunky-dory. A lot of other aspects that kick in. We will definitely look at those as we move along. But to put it in simpler way, yes, financial manager, basic functionalities are these. If it is increasing the share price and ending up maximizing the wealth of the shareholder, yes, go for that. If it is not, don't. Say for example, if there is a project coming to my company to build a bridge. We are a construction company, so we have to build a bridge. There is a requirement of, that's a project for us. So as a finance manager, of course, we will have engineers, project managers working on that at the ground level. As a finance manager, I have to take care of the funds which is put into the project. So what I do is I look at these numbers and understand if it is helping the decisions that I am looking at in terms of if I do this project from the company, is it increasing my share prices of the company? Is it helping? Or is my goodwill going up? Is my market share going up? Is it actually showing that we are socially responsible for the country? So there are many aspects a shareholder looks at, and if he says yes, and ends up increasing the share price, we will accept it. If not, if reject it. We don't, okay. To practically what happens is, we don't wait for the shareholder to say yes or no for the project that we have wanted to undertake. We will see financially what is the impact and business from the business perspective, what is the impact of such a project, and then look at if it is increasing company's wealth and profits, and in turn shareholders' wealth. If yes, go for it. If no, don't. Simple. What about the other stakeholders? Stakeholders include all groups of individuals who have direct economic link to the firm, including employees, customer. This is a new perspective. Typically, when we talk about the word stakeholders, we refer to the persons, the people who have put their money into the company. Yeah? But if you look at in a little broader perspective, we also include employees of the company, customers of the company, suppliers, creditors, owners, and other who have direct economic link to the firm. Those are all stakeholders for a company. Yeah, we cannot leave any one of these and say we have taken care of the stakeholders, only looking at equity holders. Equity holders are, of course, important. Stakeholder view prescribes that the firm make a conscious effort to avoid actions that could be detrimental to the wealth position of its stakeholder. Such a view is considered to be socially responsible. That's important for any company and the financial manager to have that perspective. Let's move on to corporate governance. That's the system used to direct and control a corporation. So it's basically how do you govern a corporation at a top level, from the top level. Okay. It defines the rights and responsibilities of key corporate participants such as shareholders, the board of directors, officers and managers, and other stakeholders. The structure of corporate governance, we did discuss that earlier. So we also have to look at individual versus institutional investors. Individual investors are investors who purchase relatively small quantities of shares in order to earn return on idle funds. I am an individual investor, say I have some savings out of my salary done, and I want to put that money to work, and I go buy some equity shares in the market as an individual. So that's individual investor. As an institution, are investment professionals who are paid to manage other people's money. Investment bankers, investment managers, those kind of guys are professions for mutual fund managers who manage a big amount of money from different sectors of public in the market. They put that money, invest that money in the market and bring out the profits. So those are the institutional investors. They hold and trade large quantities of securities for individuals, businesses and governments, and tend to have much greater impact on the corporate governance. Role of ethics, how much is important? Ethic is the standards of conduct or moral judgment have become an overriding issue in both our society and the financial community. Ethical violation attract widespread publicity. Negative publicity can often lead to negative impact on the firm. So we have to be ethically very correct in the way we deal our business. Yeah, that's very important for any financial manager. Considering the ethics, a noted ethicist suggests that the following questions to be used to assess the ethical viability of a proposed action. So these are the couple of questions that we have to keep these questions in our mind before taking any such decisions, if to look at any such proposals is ethically right or wrong to take up. Does the action unfairly single out an individual or group? Does the action affect the morals or legal rights of any individuals or group? Does the action conform to accepted moral standards? Are there alternative courses of actions that are less likely to cause actual or potential harm? Is there a different way of looking at it to minimize the risk? How can I minimize the risk is what the fourth question talks about. I hope you are able to understand this simple English here. I need not explain this, I believe. So are the rights of any stakeholder being violated? Does the firm have any overriding duties to any of the stakeholders? Will the decision benefit any stakeholder to the detriment of another stakeholder? That's another important thing that we have to take care of. It should not be obliging only some sect of the stakeholders and not the other. Say typically what happens in an example, in a typical case, we will end up looking and focusing only towards shareholders and neglect the employees of the company. But we should not. Neglecting employees will have bad impact because people leave, the talents will flow out, we will not have enough talent to take care of the business, and they will go bad mouth about the company. That's another important thing that we have to take care of. They are not engaged properly, employee engagement thing. Stakeholders, customers, along with customers, employees are also stakeholder. So that's important for us. If there is detriment to any stakeholder, how should it be remedied, if at all? Can I fix the issue? What is the relationship between stockholders and stakeholders? Stockholders are basically the guys who have put their money. Stakeholders are anyone who is related to economically for the company, to the company. Ethic programs seek to reduce litigation and judgment costs, maintain a positive corporate image, build shareholders' confidence, gain the loyalty and respect of all stakeholders. The expected result of such program is to positively affect firms' share prices. Again, boiling down to maximizing of the shareholders' wealth. If I am able to increase share prices of the firm, I am eventually increasing the wealth of the firm, eventually impacting the shareholders' wealth. If I take care of these little things, which otherwise is neglected, it will have an impact on my share prices, wealth. Agency issue, agency problem. Whenever manager, okay, let me give you this example. Say I am a manager in a company. Let's say this. Let's take this example. So we have this company. We have equity shareholders who have put their money, who are the owners, and I am one of the board of directors. I am the manager, appointed manager of the company. Yeah, and I take the decisions for the business on behalf of the shareholders, but I am very biased, so to speak, and I take my decisions which can help me to grow in my corporate ladder. Say, I am not bothered about shareholders' wealth creation, but I take wrong decisions which will only help me take my career forward, or maybe my wealth to a bigger extent, but neglect the shareholders. So that's what the agency problem talks about. So in theory, managers would agree with shareholders wealth maximization. However, managers are not concerned with their personal are also concerned with their personal wealth and career growth, fringe benefits and securities and job security and stuff like that. This would cause managers to act in the way that not necessarily be in line with what shareholders expect the business to do. So that's little thing that we have to understand here. How do we resolve these issues? Market forces such as major shareholders and the threat of the hostile takeover act to keep managers in check. Agency costs are the costs borne by stockholders to maintain a corporate governance structure that minimizes agency problem and contributes to the maximization of shareholders' wealth. Examples would include bonding or monitoring the management behavior and structuring management compensation to make shareholders' interests their own. So we have to build a system which makes the manager, work towards building the shareholders' wealth as their key deliverables in their KPIs. That makes them work towards that, and of course it will also build their career. If they are ethically right, that will definitely have a positive impact on their career. A stock option is an incentive allowing managers to purchase stock at the market price set at the time of the grant. As a manager, I am eligible to have stock options. That means I am eligible to buy the company's share. ESOPs, employee stock options. So the moment I buy the share, I become the shareholder, I become the owner, not just the manager. So automatically the responsibility will come to me, saying I have to be looking at shareholders' wealth maximization and not just my personal benefits as an employee. Performance plans tie management compensation to measures such as EPS growth. Again, KPIs, I am talking about key performance indicators, key performance areas, key result areas. Performance shareholders and cash bonuses are used as compensation under these plans. Recent studies have failed to find a strong compensation between CEO compensation and share price. Okay, that's something that we have to keep that in mind. Of the finance functions, we will have CFO is responsible for managing firms' financial affairs. Figure 1, okay, shows the finance. We did discuss about the finance functions, how it is fitting into the organization's structure, or we will show rather. Yeah, this is the one. Okay, we will have board of directors, then we have CEO to take care of the whole the company. So we will have marketing section, production and operation section. We will also have finance section, typically led by a VP finance or a CFO. His duties will be, his or her duties will be overseeing the financial planning, corporate strategic planning, control corporate cash flows. So under CEO, we will have treasurer and controller. We just discussed these two sometime back. Treasurers will have duties like cash management, credit management, capital expenditure, raising capital, financial planning, management of foreign currencies. The controller will have duties like taxes, taxation, financial statements, cost accounting, data processing, yeah, all the stuff. And that is the end of unit 1, and that is the time to take a break. Yeah, now it is about 10:40 in my watch. We'll come back by 10:45. Yeah, thank you. And keep your questions handy. Once we come back, before start of unit 2, I'll try to address those questions. Yep, thanks. It's on, right? Okay. Thank you. Sorry for the delay. Let's get on with Unit 2. I'll come out of this. Okay, so that's time value of money. For my reference, let me open this. Sorry guys, some technical issues. The mic was not working. Now it's working. Absolutely fine. Thank you. So, yeah. Time value of money. So so this is a little question that I want to ask the class. Which would you prefer? $10,000 today or $10,000 in 5 years from now? Yeah? Obviously, we want to have the cash today because we know $10,000 5 years from now will be a lot lesser in value. So that is the whole concept of time value of money. Okay? Why time? Why is time such an important element in your decision? Time allows you the opportunity to postpone consumption and interest. That means if I have money today with me, say disposable income on my hand about 10,000 rupees, I would rather buy a cell phone and consume it, as in start using it, or I give up that decision of buying a new cell phone and invest that in an instrument, maybe FD, maybe loan it to someone for some interest. Yeah, but it starts giving you returns if you invest that amount of money. Time preference for money is an individual preference for possession of a given amount of money now rather than the same amount at some future time. Three reasons may be attributed to the individual's time preference of money: risk, preference for consumption, investment opportunity. It's generally expressed by an interest rate. The rate will be positive even in the absence of any risk. It may therefore be called as risk-free rate. That means even if the investment that I am trying to make is getting me some interest, but it is absolutely risk-free. Returns, it's absolutely risk-free. So that's the risk-free rate I am trying to get. And an investor requires compensation for the kind of risk that he takes, assuming that risk, which is called risk premium. The investor's required rate of return is risk-free rate plus risk premium. So it is the combination of those two. We add up those two and then arrive at how much of required rate of return an investor is looking at. Two common methods of adjusting cash flows for time value of money: compounding and discounting. The process of calculating the future values of cash flows is called compounding. Compound interest. You would have done that math in your high school or even before that. Discounting, the process of calculating present value of the future cash flows with considering a specific interest rate. What's future value? Compounding is a process of finding the future values of cash flows by applying the concept of compound interest. I just spoke about that. Compound interest is the interest that is received on the original amount or principal, as well as on the interest earned but not withdrawn during earlier periods. Simple interest, principal into time into rate divided by 100. We all know that mathematics formula. So it's the interest that is calculated only on the original amount, principal, and thus no compounding of interest takes place. Yeah? Clear? Future value, again, the general form of equation for calculating the future value of a lump sum after n periods may therefore be written as follows. That is principal into 1 plus I to the power of n. That means interest, I is interest rate, n is number of years. So this one is P plus interest rate to the power of n, and then if you the compound value factor. The term 1 plus I to the power of n is the compound value factor of a lump sum of rupee 1, and it always has a value greater than 1 for positive I. Whenever the interest rate is positive, it indicates CVF increases as I and n increases. The moment I increases and n increases, CVF also increases. Logic? So, to substitute the whole piece here, 1 plus I to the power of n as CVF, n and I, that means principal into this is also depicted as P into CVF. If you deposited 55,000 rupees, 55,650 rupees in a bank, which was paying a 15% rate of interest on a 10-year time deposit, how much would the deposit grow at the end of 10 years? We will first find out the compound value factor at 15% for 10 years, which is, I hope all of you have got the Excel sheet and calculators with you. Do the math. That should come to 4.046. If you are not able to, I will show you how is it done. 15% to the power of 10 years. It should come to, rounded off to the third decimal, of course. So you should get something like this. Okay? Or you can do the math on an Excel sheet. Let me show you a live example. Keep an Excel sheet handy like this. So that is 4.046. That's rounded off. Okay? So that's how it is calculated. Switching back. So that multiple is multiplied to 55,650 rupees. We get 2,25,159 rupees 90 paisa as the compound value. Okay? So that's how it is calculated. So the future value of annuity. Annuity is the fixed payment or receipt each year for a specified number of years. If you rent a flat and promise to make a series of payment over an agreed period, you have created an annuity. So this is the formula for annuity. So that's amount into 1 plus I, again I is interest rate, N is number of years, you do the math. The term within the brackets, this piece is called compound value factor for an annuity of rupee 1, which we shall refer as CVFA, compound value factor of annuity. So the same formula can also be depicted as amount into CVFA for each N and I. Okay? Now, example. Suppose that a firm deposits 5,000 at the end of each year for 4 years at 6% rate of interest, how much would this annuity accumulate at the end of the 4th year? We find the CVFA factor. CVFA, which is 4.376. You know how is it done? You have to do the math. Use Excel sheet, the way that I showed you earlier. That is multiplied by 5,000, which gives me 21,873. Okay, so that becomes 5,000. Okay, let me do that in the middle of the board so that everyone can see. That's 5,000 into 1 plus 6%, right? 0.06 to the power of 4 minus 1 divided by 0.06 gives you 21,873. That's 4 years, yeah. So to the power of 4, these 4 years. So that gives you 4.3746 into 5,000, 21,873. Clear? Now moving on, sinking fund. So what is a sinking fund? So if you are an accounting graduate, you would know why do we use sinking fund in terms of depreciation. We would have studied that example. One of the methods of depreciation is sinking fund. Sinking fund is a fund which is created out of fixed payments each period to accumulate a future sum after a specified period. For example, companies generally create sinking funds to retire bonds on maturity. Another application is depreciation that I just mentioned. Yeah. So the factor used for calculating the annuity for a given future sum is called sinking fund factor. So this is a sinking fund factor. Again, Fn to the I divided by 1 plus I to the power of n minus 1. Little confusing? This is the reciprocal of annuity that we did. It's difficult, if not possible, to make such predictions with any degree of certainty. If not possible, it is difficult. So there is a way to understand and ascertain risk. Yeah. As a result, investors often use history as a basis of predicting the future. So we all know what a technical analyst do. They look at the charts of the prices of the stock market performance of an index, and then see what happens next, what kind of stocks they should buy, what kind of stocks they should sell. We will begin this chapter by evaluating the risk and return characteristics of individual assets and end by looking at portfolios of assets. Okay? What is the risk? The big picture, in the context of business and finance, risk is defined as the chance of suffering a financial loss. Yeah? Assets, real or financial. Real assets can be building, land. Financial assets can be stocks, shares, futures, options, debentures, which have greater chance of loss are considered more risky than those with a lower chance of loss. So each asset comes with its own degree of risk. If asset is riskier proposition, the chances of losing money is higher. If it is more safer investment option, that the chances of losing money is lot lesser. Risk may be used interchangeably with the term uncertainty to refer to the variability of returns associated with a given asset. Other sources of risk are listed on the following slide. So this slide talks about sources of risk and description. So it talks about business risk, financial risk, also talks about interest rate risk, liquidity risk, market risk, event risk, exchange rate risk, purchasing power risk, and tax risk. I think this is more self-explanatory rather than me spending time. It's ideal you guys go through this and get an understanding of what kind of risk means what. Moving on, returns. Return represents the total gain or loss on an investment that we make. The most basic way to calculate return is CT plus PT minus PT minus 1 divided by PT minus 1. Okay, let's take a moment to understand the whole thing here. R1 is that RT is on the left hand side. That means the actual expected or required rate of return during the period T. Okay, so let's take T as 2 years. In 2 years, what is the return that I want to make is what R represents. That's the thing that we want to find out using this formula. CT stands for cash received from the assets or asset investments in the time period T minus 1 to T, in last 1 year or so. T minus 1 is 1 year, T equals 2 years. So you have that ascertained. C, R is all done. PT is the price value of an asset at the time T, and T minus 1 is price value of asset at time T minus 1. So on, say I have invested in equity share. I want to understand what's the return I get. So that's CT is the dividend that I get over a period of time. Say 100 rupees that I have got dividend plus in last 1 year. PT is the price value of the at T now. So it is at it's trading at 105. I bought it at 100. Yeah, and 100 rupees dividend. Okay, let me give you lot lesser amount here. Say 5 rupees dividend, and this is what I got. So that is 5 plus 5 divided by 100, 10%, or that's the return I have got over a stock. The amount of revenue that I was able to make plus the current price minus the initial price at which I bought divided by the initial price I got it at. Okay, so that's the formula. Moving on. Yeah, returns defined. The rate of return on an investment can be calculated as follows: amount received minus amount invested divided by amount invested. I had put my okay, for example, $1,000 is invested and $1,100 is returned after 1 year. The rate of return for this investment is 1,100 minus $1,000 divided by amount invested is $1,000 is 10%. Okay. Investment risk defined. So what is investment risk? Two types of investment risk: standalone risk, portfolio risk. Just a minute. Excuse me for a while. The investment risk is related to the probability of earning a lower or negative actual return. Done. So coefficient of variation. The coefficient of variation is the measure of relative dispersion that is useful in comparing risk of assets with differing expected returns. Simply put, CV, again this is also done in statistics, standard deviation divided by R bar. Okay, now looking at example, the expected return of asset C and asset D are listed here. Okay, yeah, couple of pointers, standard deviation, coefficient of variation. So now expected return 12%, standard deviation is 9%, and 2 divided by 1, which is 9 divided by 12 is 0.75, 20% and 10%, again 10 divided by 20 is 0.5%. So if you just look at standard deviation as a measure of returns, in this case asset C is better because it's a lot less riskier. If you look at coefficient of variation, 0.5 is better because it is lesser than 0.75. So there are two ways of looking at it. So portfolio construction, risk and return, an investment, okay, portfolio, before we get into the details of this slide, portfolio is a bunch of stocks or a bunch of investment instruments ranging from stocks, mutual funds, debentures, anything. It is managed professionally. So it is highly important for us to understand risk and return concepts while constructing a portfolio. An investment portfolio is any collection or combination of financial assets. If we assume all investors are rational and therefore risk averse, they are not very prone to risk, they are risk averse, they don't want to take risks, or they want to avoid the risk and get maximum profit or returns, so to speak. The investor will always choose to invest in portfolios rather than in single assets. There is an advantage of putting your money into single assets. There is a old saying, don't put all your eggs in one basket. If the basket falls off, all the eggs are spoiled or broken. You don't get anything. So keep your eggs spread out. Even something goes wrong, you have other things to fall back on. So don't put your money, all of your money in some stocks or on single stock. If that stock fails to perform, you will lose money. Instead, spread your money into different instruments so that even if there is a loss in one asset, you can gain a profit in another asset. So you have to put your money judiciously with your calculations and judgment. Investors will hold portfolios because he or she will diversify away a portion of the risk that is inherent in putting all your eggs in one basket. I just spoke about that. If an investor holds a single asset, or he or she will fully suffer the consequences of poor performance. If that works, works. If doesn't work, we go bonkers. This is not the case of an investor who owns a diversified portfolio of assets. So that's very prudent thing to do, being financial graduates, to diversify our investments. Assume a two-stock portfolio is created with $50,000 invested in both HT and collections. Expected return of portfolio is a weighted average of each of the component asset of the portfolio. Standard deviation is a little more tricky and requires that a new probability distribution for the portfolio returns be devised. Let us look at this example. KP, a cap, is a weighted average equals weightings into the returns. Basically, they are multiplying this. There is an example in the coming slide. So this is the example that is provided. Economy, recession, below average. These are the different cases of economy, stages of economy, and each is given a probability weighting. And HT in the collection is the kind of returns that they are getting, and the portfolio that they are able to return that they are able to get. Okay. Now, how do we calculate this? Point I'm so sorry. This is calculated with multiplying this column into probability factor. That's what we discussed in the last slide. 0.1 into 3% plus 0.2 into 6.4%, 0.4 into 10%, 0.2 into 12.5%, 0.1 into 15%, which is 9.6. Now, after that is arrived, we take one step forward. 0.1 is the probability factor into 3 minus 9.6. Okay, 3 minus 9.6, the deviation that we look at. Okay. Let us look at an example on an Excel sheet. Okay, let me change my position. I'm not able to see the screen. Copy the whole thing, put it here. Okay. Now, what did we do? We multiplied, this, and we did a summation into percentages. 9.6. Now, after that, .9. Okay, we took difference of these two and we squared it. Okay, tricky here. And we summed it. No, we did multiply this with the probability again. And we took summation and then we square root. We took the square root because we had squared it earlier. Okay. Now, so that's 3.3 here. Then we take 3.3 divided by 9.6. .34 or 34%. So typically it's decimals, 0.34%. I hope I was not fast in showing you the whole thing. You can do this math on a simple Excel sheet, lot easier to understand. So first we take this and multiply it by this and take the sum. From sum we take the deviation, square the deviation. Since we need the absolute values, there are a couple of minus signs here, negative signs, then we square it. Then we take the probability factor again and then sum it and then look at the division, look at the expected return, CV, coefficient of variation. Okay, cool. Let's move on. Okay, done. The risk you cannot get rid of. Yep. CAPM, capital asset pricing model. The risk you cannot get rid of by adding stocks, which is called systematic risk, cannot be eliminated through diversification because the variability is caused by events that affect most stocks similarly. Examples would include changes in macroeconomic factors such as interest rates, inflation, and the business cycle. So we cannot avoid those. We have to consider those while we take our decisions. So capital asset pricing model talks about, this is an example of how do we go about calculating and understanding the model. Benjamin Corporation, a growing computer software developer, wishes to determine a required return on asset Z, which has a beta of 1.5. The risk-free rate of return is 7%. The return on market portfolio of assets is 11%. Substituting BZ to beta 1.5, RF to risk-free return 7%, and KM, which is 11% market portfolio return, into CAPM yields the following. 7% is the risk-free return plus beta into 11 minus 7 will give me 13%. Okay? So that's the depiction of the whole calculation on a graph. So this is the concept of security market line. So this is the risk-free return line. Okay? And then from there the market risk premium starts kicking in. The more the premium, upper the line. Yeah. So market risk premium 4%, 6%. If I am looking at 11% of required return, it is coinciding at beta 1. 1.5 is 13. Inflation shifts the security market line. So if there is a change in the inflation, again the market line parallelly shifts up, and correspondingly the rest of the factors are all changing. Risk aversion shifts SML. If I am more averse to risk, the slope of the line is different. If I am less averse to risk, the slope of the line is different. So I'm able to take high risk means it is more steeper. If I am not very high risk taker, the slope is lot moderate. Risk and return, the capital asset pricing model does explanation. The CAPM relies on historical data, which means the beta is the risk. May or may not actually reflect the future variability of returns. Therefore, the required returns specified by the model should be used only as rough approximations. The CAPM also assumes markets are efficient. Although the perfect world of efficient markets appears to be unrealistic, studies have provided support for the existence of the expectational relationship described by a CAPM in active markets such as NYSE. Okay, so that's about end of the slide. Again, I need a break. 12 o'clock, another 2-3 minutes. I'll come back. Once we come back, we'll see. Okay, we'll go to the next module, which is end of unit 3. So we'll go to unit 4 and look at what's there for us. Okay? Thank you. I'll be back. Let's start. Okay. I would need another couple of minutes. My laptop is running out of the battery. I'll be back in a minute. Okay, let's start. Give me a minute. Let me boot my system. It had switched off. I would suggest you go back to those formulae that we discussed in the last unit and try to make sense out of each of the formulae, because those are little tricky and little critical for the course. Since there are a lot of topics to be covered, I am not going into each of these formulae into deep. I would suggest you go to the textbook, refer, come back with questions. We can always take it later. Okay, now, so this is unit 4 we are starting with. What is security? A legal representation of the right to receive prospective future benefits under stated conditions. W.F. Sharp, Alexander and Bailey are the guys who have defined this. So security is anything that is legally helping us or legally binding to to get a return, prospective future benefits under stated condition. What is capped? Okay. Types of securities: bonds, stocks and derivatives, main ones. There are important securities in the capital market. Pure discount. Okay, let's look at types of bonds. Pure discount or zero bonds, it is a single promised payment at the maturity date. There is no dividends, no interest provided in between. Examples: treasury bills, corporate zeros or strips. Those are types of bonds. So in this case, a issuer issues a bond, and on the maturity date of the bond, he gives back the money. If it is 100 rupee, he will give back 100 rupee only. There is nothing else that I can gain out of the whole investment. So this will be a very short-term investment, so to speak. So consols. The next one, consols. Console is a name which is most popular in Britain. So it's a bond which pays a fixed coupon each period forever. There is no end date. It keeps on paying. Next is coupon bonds. Pay regular, typically 6 months. Coupon payments plus face value at the maturity. Coupon means interest for tax purposes. For every 6 months it pays interest. So in this console also, specific coupon is paid forever. There is no end date. It keeps on paying. Coupon bonds. Example: most corporate or long-term government bonds. Okay, if it is bothering you. Okay. Pricing zero bonds. How do we price this? Price is equal to present value. For a zero coupon bond with T years to maturity and a face value of F and a constant discount rate of R, price equals to F divided by 1 plus R to the power of T. Example: face value is $1,000, discount rate is 10%, years until maturity, which is T, is 8 years. So if you do the math, you get $466.51. Okay. Now, pricing discount bonds. I would leave you a minute to go through this slide, understand a little bit. Definitely I'll explain this. We have two discount bonds. So that's bond 1 and bond 2. We have present value given for a period of 2 years. What can we infer about the 1 and 2 year spot interest rates at time 0? So based on the present value, we can look at R1 being 7%, R2 being 9, returns are better in R2. So I hope you understand the formula. 1 plus R to the power of T. R equals, R goes to the left hand side, PV comes to the right hand side, and then we have to do the math, and then minus 1 is appears here. If you look at out of this formula, if I try to find R, this is the formula we get. F divided by PV to the power of 1 by T minus 1. Okay, so that's the formula. If you apply the formula, you get 7% and 9%, R1 and R2, and try to figure out which is better. Okay, so receive coupon payments perpetually. Face amount is never paid. Consoles. For a console with T years to maturity and a face value of F and a constant discount rate of R, price equals to, okay, let me show you this, sorry for that. Okay, so T years to maturity and a face value of F and a constant discount rate of R, price equals $C divided by R. Okay, because there is no maturity period. Example, $50 received monthly in perpetuity, stated annual rate is 8%, monthly rate is, I'm so sorry, I'll have to take a break, sorry for that. Sorry, I will not take the call. Okay, monthly rate is 8% divided by 12, which is 0.6667% rounded off. PV is C divided by R, which is $50 divided by the rate that we arrived at to arrive at $7,500. Pricing coupon bonds. Okay, what is the present value of 2-year $100 par value bond paying 10% interim? Interest semi-annually if required rate is 8%, compounded semi-annually. So we have $100 value bond paying 10% interest semi-annually. So if it is 10%, it becomes $10 per annum. Semi-annually means for every 6 months, it becomes $5 for every 6 months. And if the required rate is 8% compounded semi-annually, so this is the math that we arrive at. C into A plus F divided by 1 plus R to the power of R. Okay, so if you do the math, you will get $103.63. R is 8%, T is 2 years, C is $5, F is $100. If C equals R, that means price equals face, it is par. If C is less than face, that is discount. If price is more than face value, it is premium. So that's how pricing of coupon bonds happen. Bond maturity and interest rate risk. The value of a bond depends upon the interest rate. As interest rate changes, the value of a bond also varies. There is an inverse relationship between the value of a bond and the interest rate. If the interest rate goes up, the value of the bond decreases and vice versa. The intensity of interest rate risk would be higher on bonds with longer maturity than those in short periods. Using the following 3 types of bonds, we can identify the situation. So this is an example: 5-year bond, 10-year bond, perpetual bond, 7% interest rate, maturity value 1,000 and perpetuity. If you look at the table, so for every change in the interest rate, you can look at the changes in value 5. I'll tell you what, instead of doing this and looking at a slide, I want you to do it on an Excel sheet and try to find out what the changes each bond is going through for every change in the interest rate. That would help you to understand this in a lot deeper sense. Okay, not just looking at a slide and trying to figure out what is 1134, what is 1087, what is 875, what is 1750 and stuff. I would want you to go to Excel sheet, do this, and then do the math, put the formula in Excel, and then figure out what's happening, what's the impact of interest change on each of these 3 types of bonds. Okay, and now preference shares valuation. What is a preference share? Preference share is a type of owners fund which has got preferential rights when it comes to in an event of liquidation. They have preference of getting back their money, also preferential rights to get their dividends. Hello. I'm in middle of the class. Assume that a preference share pays rupees 12 as dividend annually. What is the value of share if the current required rate of return is 10%? Okay, so I have a preference share which is paying me 12 rupees of dividend every year. What is the value of share that I have got if the current required rate of return is 10%? So if I do the math, 12 is the dividend that I get divided by the percentage of required rate of return, that is 10%, which is 0.1 in decimals. It gives me 120. 120 is the value of preference share that I have got. Okay, that's quite simple. Equity share valuation on another type of investment asset instrument that we have is equity. We all know equity shares are the most important thing that we have to understand while we get into financial management and the markets. One of the most widely used equity valuation model is the dividend discounting model, which is also called as DDM. The DDM defines the intrinsic value of a share as the present value of future dividend. Now, there are several valuations of the DDM because of different assumptions about growth rate of dividend and the relationship to the discount rate used to calculate present value. Go through this slide, take a minute to understand, we'll move on. Okay? There are three things. Oh, I'm so sorry. Zero growth model, constant growth model, or normal growth model. The supernormal growth model is the optimistic view that we want to look at. Zero growth model, this model assumes that the dividend will be constant over a period of time, so that growth is zero and the investor's required rate of return is constant. Sorry. Okay, this implies D1 equals D2 equals to D3. It's constant. Every year I am getting same amount of dividend irrespective of the life of the company and the growth that it looks at. So we are looking at zero growth basically. So if we are able to pay 10 rupees as dividend per share, we maintain 10 rupee every year. So that's constant. So the formula becomes D divided by 1 plus R to the power of 1, which is first year to the second year, third year, up till to the nth year. D divided by KE. Assume that the dividend per share is estimated to be at 4 rupees per year and indefinite. The investor requires 20% of return. Find the intrinsic value of the equity share. So that becomes 4 divided by 20%, which is 0.2, equals 20 rupees. So constant growth model. Okay. This model assumes that dividends will grow at a constant rate every year. If we use G for the constant growth rate, we can show the dividend 1 year from now as D1. D1 equals D0, that's dividend given at year 0, into 1 plus G, that's the growth rate. D2 is D0 plus, sorry, D0, 1 plus G to the power of 2, which is 1 plus G into 1 plus G. So dt is D0, 1 plus G to the power of T. P is defined as D1 divided by KE minus G, that's growth. Okay. So if an investor has a share whose current cash dividend is rupees 6, the constant compound rate is 15 per year and the required rate of return is 24, find the value of equity share. So if I do the math, looking at the formula, that becomes 76 rupees 67 paise. 6.9 divided by 0.09. Okay. Current dividend is rupees 2.3. Required rate of return is 13%. Constant growth rate is 5%. Find the value. Another example. The dividends of HPT over the last 5 years have been as follows. HPT is a company, so this is the kind of dividend that we have seen in the past for last 5 years. The company entirely financed by 100,000 equity shares. Sorry for that. Expected rate of return on equity shares is 24%. You are required to calculate the growth rate over the last 4 years. The value of equity share is what? 1,50,000, 2,62,550. D4 is that. So if you do the math, it will become 15%, and then finally you arrive at the value 33.55 rupees as the answer. Constant growth model. Okay, let me go back to the slide. Take a look at the calculation, understand what's happening here. If you have a doubt, please ask questions. $2.6255 into 1 plus 0.15, which is the rate, divided by 0.24 minus 0.15, KE minus G, that's the growth rate, 0.15, equals 3.019 divided by 0.09, which is 33.55. Okay, now moving on. Constant growth model. The model is based as following assumptions. Okay, so it comes with set of assumptions. If it is a model, if it's a theory, then we have to look at that. The required rate of return, which is K, must be greater than the growth rate. So it cannot be less than, so it has to be a positive when we deduct growth rate. The initial dividend must be greater than 0. So it cannot be D0 is not equal to 0. It should be more than 0 always. The relationship between K and G is assumed to be constant and perpetual. So it's a constant growth model. So there the relationship between is also assumed to be constant. So multi-period dividend discount model. D1 divided by 1 plus K to the power of 1. Again, up till Dn plus Pn divided by 1 plus K to the power of N. Pn is expected sales price of stock at time N. N is number of years stock is to be held. So if I multi-period earning, VO is 1 plus B into E1 divided by 1 plus K to the power of 1. Likewise, 1 minus B En plus Pn divided by 1 plus K to the power of N. So that's Pn again, expected sales price of the stock at the time N. N is number of years the stock is to be held. PE ratio and growth opportunities. So PE ratio is price earning ratio. This is one of the critical things that an investor looks at when he wants to put his money into any company. So what's the ratio between price and earnings? So B is retention ratio, ROE is return on equity in this formula. So D1 divided by K minus G equals E1 into 1 minus B divided by K minus B into ROE. So that's the formula that we look at. PE ratio 1 minus B divided by K minus B into ROE. If you actually get into ratio analysis, the way PE is looked at is in a slightly different way, lot easier formula to understand. The concept is what's the earning, what's the price of the share that we are looking at. Okay, are we looking at the price in the right direction as against the earnings and vice versa is what we're trying to compare in PE ratio. That gives one of the critical indicator for any investor to put their money. That's the end of the slide. So we are done with unit 4. Lot of formula that we covered in unit 4. I want you to go through the slides crucially, critically, every slide, and understand these formulae. Each formula will take a couple of hours to explain, since we are looking at different concepts clubbed into one, and we have another 5 more units to go. Then since the topics are more, then I am not dwelling deep into each of these topics. Go through those formula, understand, solve some couple of examples given in the textbook. Go through the text part, the theory part of it, understand what is what, and if you have doubts, get back to me. I can always answer those questions. Yeah. So now it is 12:45. Let's break for about 5 minutes. I need to regather my voice. I'll come back. Yeah. Thanks. Okay, let's start with the final unit. So this unit is cash flow and capital budgeting. Okay. Now, capital budgeting is used to make investment decisions. So we did discuss this at the beginning of the class. Investment decisions, a firm as a finance manager, you will have to understand what kind of investments that you have to make for the growth of business and how do you fund it. Those are the important decisions on the working capital decisions, of course. So this flow chart, so to speak, depicts how it works. So as a firm, this is finance decision. So the kind of sources that I get: loan, equity, debenture. Yeah. So this is the amount of money I want to get in. How do I get it? I get via refinancing. I go to financial market to pool the money, and I also have this obligation to give the returns to security holders. All money comes here. Okay. Little animation. So once I get the money, I look at where do I put my money in: machinery, land, building, plant, manufacturing unit. Okay. Then real assets. How do I reinvest that money? And return from investment. How do I ensure that I don't make any losses out of those returns, or it's on a positive note. Okay, positive number. So this is the flow chart that explains the theory that we discussed in the beginning of the class. Investment decision includes expansion, acquisition, modernization, replacement, new product investment, obligatory and welfare investments as well. Expansion of the business, expansion of the branch office, maybe expansion in terms of having new machinery. Because of the demand, I have to produce more and I need more machinery. I expand my plant. Acquisition, there is a small player which is in the same industry. As a business, I think if I acquire that business, small business, it will help me grow my business. The recent acquisition that we all have seen, the portal Myntra was taken over by Flipkart. Jabong was taken over by Flipkart. So that's acquisition. So Flipkart and Myntra is part of the Flipkart. It thinks acquiring Jabong will help grow the business. Modernization. The technology has changed over a period of time. I have to upgrade my technology. I need more money to do that. Replacement. Old machinery is not working now. I need new investment to be put to purchase new machinery so that I run my business smoothly. New product investment. The market is so fierce with competition. If I don't innovate, I perish. The new product investment, I have to build a new product, and for that I need investment. I need in R&D. Obligatory and welfare investment. I have employees. I have to take care of their welfare. Legal aspects. I have to spend money. Ensure spend money to ensure legally I am taking care of everything. To spend money on a chartered accountant or a company secretary or a lawyer so that legal compliances are all met. Yeah. When I mean spend money that I am all legally binding, it's not bribing, it's on papers the kind of professional fees that we would like to pay to all these professional services that we receive for our company. That's very obligation. So for income tax filing or submission of my final accounts, reports, we pay money to chartered accountants, company secretaries, lawyers, yeah. Lot of documentation involved, legal documentation involved in terms of acquisition of a company. So we would definitely need a lawyer's help. So we are paying him professional fees, that's obligation. Welfare investments, I have a workforce of 5,000 people working in my company. I want to provide them with good food in the during afternoons. That's an investment. I have to put up a canteen, good healthy food preparation. So hygienically it is all abiding by the standards that are defined. So that's investment for me. Includes outflows on R&D. You can tie that back to product development. Also major advertising campaign. I have got my product in place. I want people to know about my product. I go and advertise. I put up on TV, newspaper and whatnot. Okay, so that's costs. Investment decisions again can also be categorized as conventional projects, non-conventional projects. Based on this, I decide if I have to put my money in that or not. Features of capital budgeting decisions. They have long-term consequences. They often involve substantial outlays. Outlays means capital investments. They may be difficult to or expensive to reverse. If I do this, I cannot pull it back. Construction of roads, construction of dams, bridges, those kind of projects can be examples here. Huge investment involved. The moment I say it's not working, I cannot pull it back. I have to complete it. I cannot leave that road halfway without construction. The expenditure and benefits of an investment should be measured in cash and not in accounting profits. So that's another thing that we have to look at. Accrual thing and cash viewpoint that we saw in the beginning of the class ties back to this. Why cash flows provide a better estimates of projects' true returns. Accounting profits are at the end of the end result of a number of accounting decisions. These can be manipulated through the use of creative accounting. No business accepts profits as payments for goods and services delivered. All of them require cash. Thus, cash flows provide a better estimates of a project's true return. I think the second point nails it. No explanation needed. If you go through, you would know, so understand. Okay, investment decisions. Again, continuing with that. Investment evaluation criteria, estimation of cash flow, estimation of cost of capital, application of a decision rule for making a choice. Capital budgeting decision techniques. Okay, before going into capital budgeting decision techniques, investment evaluation criteria for any investment that comes for evaluation in front of a financial manager, finance manager of a company, he would do these exercises in his office. Estimation of cash flows, how much cash flows I would get if I do this project at the end of 5 years, 2 years, 3 years. Estimation of cost of capital, how much is the cost that I have to shell out to acquire the capital, what's the cost. Application of decision rule for making a choice. There has to be a logical way of looking at it, so there has to be a decision rule that I have to look at for making a right choice. Capital budgeting decision techniques. Okay, discounted cash flow techniques. So just a minute. Yeah, capital budgeting decision technique, discounted cash flow techniques means the techniques which helps me as a finance manager of a company to look at projects, how much of cash flows I am able to get out of this and what is their impact in terms of helping the company's value to go up. I need a break, just a minute. The methods are net present value method, internal rate of return, it's called IRR, modified internal rate of return, profitability index, few techniques which we look at to take a capital budgeting decision. Non-discounted cash flow techniques are payback period. The process of identifying, analyzing and selecting investment projects whose returns, which is cash flows, are expected to extend beyond 1 year. So that's capital budgeting. The process of identifying, analyzing and selecting investment projects whose returns are expected to extend beyond 1 year. Generate investment proposals consistent with the firm's strategic objective. The long-term strategic objectives would have been defined by a firm. So generate my proposals in line with that. It should be consistent with what we want to achieve in the long run. Shareholders' wealth maximization. Then estimate after-tax incremental operating cash flows for the investment projects. Evaluate project incremental cash flows. Select projects based on a value maximizing acceptance criteria. Reevaluate implemented investment projects continually and perform post audits for completed projects. Ensure it's all working in tandem and it's all put in place. Yeah, that's the process. Is the heading discounted cash flow techniques. The main DCF technique for capital budgeting includes net present value, NPV, IRR and profitability index. Each requires estimates of expected cash flows and their timing for the project. So we should know how much of money I am getting after 1 year for this project, after 2 years, after 3 years. Each requires that including cash flows, cash outflows, which is cost to the company, and inflows, revenues for the company or savings for the company. Normally tax effects are also considered. So on these there will be tax which is coming our way. We cannot evade tax or avoid tax. That's wrong, ethically wrong. On revenues, on the profits, we will have to pay taxes. So that will also have an impact on the kind of cash flows that we end up with, cash inflows. Each requires an estimate of the project's risk so that an appropriate discount rate, opportunity cost of capital can be determined. The discussion of risk will be deferred until later. For now, we will assume we know that relevant opportunity cost of capital or a discount rate. Sometimes the above data is difficult to obtain. This is the main weakness of all DCF techniques. Net present value is net present value of a project is the sum of the PVs of all cash flows, present values of all cash flows, positive as well as negative, that are expected to occur over the life of the project. NPV profile, a graph showing the NPVs at various discount rates and helping in computation of IRR. It is curvilinear relationship between NPV for a project. This is a little tricky. I think we need the graph to show, which is not available on the PPT. So this talks about how is it impacting. When the discount rate is 0, NPV is the highest. At the point where NPV curve intersects the horizontal axis of the graph, the NPV is 0, and by definition this is the IRR. IRR is the rate of return which is considered. If we assume that NPV is 0, what is the rate that would apply to make NPV 0? That is considered as internal rate of return. Properties of NPV. NPVs are additive, intermediate cash flows, are invested at cost of capital. NPV calculations permits time varying discount rates. Net present value, we have an example here. Method NPV equals PV inflows minus PV outflows. If NPV is more than or equal to 0, then accept the project, otherwise reject the project. There is an example given here. Initial investment required $100,000. Opportunity cost of capital is 15%, which is again discount rate, and the NPV is, we have the cash flows given here. I want you to go to Excel sheet, do this mathematics and come out with the answer. Okay, what I'll do is I'll sort of share the whole thing. I had done an Excel sheet to show you how it works. What I'll do is I'll try to recreate the whole thing now on Excel sheet for you. Now, let's go back to an Excel sheet. Okay. Let's take this, copy the whole thing. I cannot see this, sorry for that. I hope this is visible. Okay. Now the first year is 20,000. It's not 9th February, it is 2 to 9 years. So that becomes this goes to 10th year. This becomes okay. So between second year and ninth year, you're getting this. For convenience sake, okay. So now we have to include another row here as 0, which is the initial investment, which is 100,000. Okay. All right. Now we need to calculate the NPV. So let's name it as CF, cash flows. That's NPV. What's the formula for NPV? This divided by 1 plus, what's the percentage? 15% raised to the power of year. Okay. Now I hope you are able to get this formula here. Now I am dividing for the first year. This is the formula. If I copy paste, so these are the cash flows I get. Sum all the cash flows from year 1. So I get 1,75,944. So these are all in dollars. Okay. Now this is the amount of cash flow that I get. The NPV is 1,75,000. Okay. Even to put it in a bit easier way, there is a specific formula on NPV. %, minus this. Sorry, it is 15% at the beginning, then you give the value. So that's the same thing that we got. So directly we can use NPV formula on Excel sheet to arrive at the value. On the column C, I have made the calculation to show you how is it done. Directly you can also get the calculation. Moving back. Okay, I don't need this. These are all done. Yeah, this is there. Okay, this is how it's done, but I've anyway shown you a different way of doing it in the Excel sheet. So you can use either of the one. Okay. Strengths and weaknesses of NPV. Strengths, resulting number is easy to interpret, shows how wealth will change if the project is accepted. Acceptance criteria is consistent with the shareholder wealth maximization. In line with that, relatively straightforward to calculate, no too much of calculation, it is relatively easy to understand and calculate. Weaknesses, requires knowledge of finance to use. Yeah, an improper NPV analysis may lead to the wrong choice of projects with the firm has when the firm has capital rationing. This will be discussed later. Okay. As a firm, if I have a limited amount of capital to be rationed with different projects, and if I take a decision wrongly based on wrong NPV calculation, it can go wrong, severely wrong. Internal rate of return, IRR, is the rate of return that a project generates. Algebraically, IRR can be determined by setting up an NPV equation and solving for a discount rate that makes the NPV equals 0. Equivalently, IRR is solved by determining the rate that equates the PV of cash inflows to the PV of cash outflows. Method. Use your financial calculator or a spreadsheet. IRR usually cannot be solved manually. If IRR is equal to or greater than or equal to opportunity cost of capital or hurdle rate or discount rate, then accept the project. Otherwise, reject it. Let's go back to the same example. See how IRR is done. Note this. Go to Excel sheet. So there is a formula called IRR. The moment you put the formula, okay. If I go to this IRR, it will help me to build the formula. Okay. Reference. So here I give it as cost of capital 0.15. Okay. Something is wrong. Should be 11 point something. Okay. Let's look at it later. Just a minute. Okay, let's go back. I had done my calculations earlier, so I'll just refer my note, and then okay, I get that. What I'll do is I'll go to IRR formula. I select all the cash flows including, and then I give 0.15%. It will not work because I should consider cash outflow as negative here. Here, if I put, okay, so that's 32% is IRR, and okay, so that's the formula. Superb. Now going back to the Excel sheet presentation, IRR equivalent. Okay, if IRR is more than the cost of capital, in this case it is, we have to accept the project. Okay, this is how it is done in the calculator. I have anyway shown you on the Excel sheet. Strengths and weaknesses. IRR number is easy to interpret, shows the return the project generates. Acceptance criteria is generally consistent with the shareholder wealth maximization. Weaknesses: requires knowledge of finance to use, of course. Difficult to calculate, need financial calculator or Excel sheet. You cannot do it by hand. It's a little difficult. Of course, we can always do this by hand. We all learnt it without Excel sheets. It's possible that there exists no IRR or multiple IRRs for a project, and there are several special cases where the IRR analysis needs to be adjusted in order to make a correct decision. These problems will be addressed later. Okay, there are specific cases where IRRs have to be relooked at and adjusted accordingly, so that we can go ahead with the decisions, yes or no, either way. So next is the profitability index method. Present value of cash flows after the initial investment divided by initial investment. Note, PI should always be expressed as a positive number. If PI is more than or equal to 1, then accept the real investment project, otherwise reject it. It's the same example. Let's calculate PI. Let's go back to the Excel sheet. PI is simple. Cash flows divided by the inflow. So what I do is, sum of these, okay, now this is divided by, actually that's positive, so that's 1.76 is the profitability index, again which is more than 1, we can accept the project. Again, how is it calculated on a calculator? I've shown you how is it done, so you don't have to worry. If you just need calculate PI, then follow same thing. Strengths and weaknesses of profitability index. PI number is easy to interpret, shows how many dollars you get back per dollar invested. I invested $1 lakh, $100,000, and I get 1.76 times. Yeah, and for every $1 spent, I got $1.76 back. So 0.76 extra that I'm getting, which is good. Sorry for that. Acceptance criteria is generally consistent with shareholders' wealth maximization. Relatively straightforward to calculate, useful when there is capital rationing. Yep. Weaknesses: requires knowledge of financial use, possible that PI cannot be used if the initial cash flow is an inflow. Methods need to be adjusted when there is mutually exclusive projects. Okay. Payback period. Payback period provides a firm an estimate how rapidly a project payback is happening. A project payback, its initial investment. This method does not consider the time value of money. So it's straightforward formula: initial investment divided by annual cash inflow. Many different definitions for average accounting return. Okay, average accounting return is another thing that we have to look at. Typically it is accept the project if AAR is greater than the target rate. Average book value depends on how the asset is depreciated, requires a target cutoff rate requirement. Sample project data, we have example here, 1,65,000, which is minus, which is going out. Year 1, 63,120. We also have net income, 13,620, 3,300, 29,100 for 3 years. Year 1, Year 2, Year 3 cash flows are also given: 63,120, 70,800, 90,000, 91,080. Average book value is $72,000. Required accounting return is 25%. Average net income is calculated this way. So we take the average of these three divided by 3, which is 15,340. That goes to the numerator. 72,000 is the average book value, which is the denominator. The value that we get dividing is 0.213, which is 21.3%, which is compared with 25% required average accounting return, which is less than, don't accept it. Simple. So if it is great, accept the project if the AAR is greater than the target rate. In this example it is less, so we are not accepting the project. Okay. Advantages and disadvantages of AAR: easy to calculate, needed information usually is available. Disadvantages: not a true rate of return, time value of money ignored, uses an arbitrary benchmark cutoff rate based on accounting net income and book values, not cash flows and market values. So this can be little tricky, going back to the concept of accrual and accounting and finance concepts. Yeah. So those are the advantages and disadvantages. So that is the end of unit 5, and that brings us to the end of this session. Thank you for your patience. I will take the rest of 4 units, I think one of the Sundays, first Sunday of the September, and we'll complete those units on the day. Yeah, thanks for your time. Bye. In the meanwhile, I want you to go through the slides, understand those formulae, and come out with your questions. Let's look at those questions in the next session. Thank you.